From the morning reading, diamonds, spiders, and Qs, another new high close. Financials, healthcare, and a bull flag setup. 8 of 9 sectors moved higher and 1 was unchanged on Thursday. XLE, XLY, and XLI were the strongest sectors, while XLP was the weakest sector. Oil futures rose $1.97 to close at $43.46. Breadth strengthened compared to the prior session as advancers led 1876 to 1101 on the New York Stock Exchange and led 1656 to 959 on the NASDAQ. On the S&P 500 snapshot, a record close thanks to retail earnings and an oil bounce. The Dow, NASDAQ, and the preferred equity benchmark S&P 500 all closed at record highs today. The 500 opened higher at its intraday low, triggered in part by better than expected earnings of retailers, most notably Kohl's and Macy's, which ended the session in a breathtaking 16.17% and 17.09% gains. A huge rebound in oil prices also buoyed the market. West Texas Intermediate crude ended the day with a surge of over 6%. The 500 hit a record intraday high, up 0.60% before setting a 0.47% gain at the final bell, a record close. Treasury sold off on today's equity rally. Closing yield on the 10-year note rose 7 basis points to 1.57%. Also in the morning reading, the big three indices have all reached new highs. The S&P 500, Dow, and NASDAQ Composite all closed at new all-time highs on Thursday, the first time since 1999 that all three did so on the same day. Over the past 40 years, when all three reached new highs at the same time, buyers usually took a break over the next couple of weeks, particularly when it had been at least a year since the last time all three were at new highs. Active managers continue to bet that those highs will continue. Their average exposure to the stock market has been above 90% for 5 straight weeks, and the confidence in that outlook is also historically high. The only time since the survey's 2006 inception that they had been this long and confident was at the end of 2013. Corporate insiders aren't as confident. According to Bloomberg and the Washington Service, the fewest officers and directors purchased company stock in July than any month since 1988. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:59 a.m. Mountain Time, and I'm recording this in preparation for the market day of August the 12th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive into the morning report. Okay, there we go. At the time of this cut, all 4 of the broad market indices were down, albeit just below scratch, so nothing of significance. Crude oil continues its surge. It's up over 0.5%. The euro up over 0.5%. Bonds up over 1%, and gold up about 0.75%. In overseas action, mixed, with China up strongly at 1.6%, Hong Kong up about 0.8%, Japan up over 1%. Germany is down about 0.25%, and the FTSE in the United Kingdom is down just below scratch. In terms of macroeconomic reports for today in the United States of note, we have a cluster with the core retail sales, PPI, retail sales, and core PPI month-over-month reports all coming out. Later in the day will be University of Michigan consumer sentiment, so be on the lookout for that as well. In terms of current volatility conditions, we continue to be abnormally low. Look at the short-term VIX, now below a 10, a 9.74. SKU also has eroded a little bit down to 131, still in a cautionary stance. IV percentiles are about as low as it can be historically. The S&P, the NASDAQ, and the Dow all at 0. The Russell is at a 4. Standard deviation moves were put in yesterday by the S&P and the Dow on a close-to-close basis. Keep that in mind. We've had 3 standard deviation moves in the last 2 weeks now on the S&P, so we're starting to get a little bit of a more normal mix of volatility and in terms of price action at least, if perhaps not in terms of fear. These IV percentiles and so forth are very, very low. Let's go ahead and bounce over to the charts. So in the S&P 500 futures chart, you can see we did indeed yesterday set both intraday and closing all-time highs. We also did that on the NASDAQ and the Dow, so all 3 of the primary indices. Last night's action, very small range, perhaps giving up just a teeny bit of that yesterday, but nothing really of significance. This is just really noise and chatter at this part with no real direction. In terms of the Dow, you see the breakout yesterday, and this is significant not only in that it broke out from the sideways action, it cleared these recent swing highs. So we now have both this diagonal breakout and a horizontal breakout and have busted up into this new air. So I probably would call this another one of those horizontal bull flags breakouts. So we've had a pair of breakouts of recent on the Dow, so that one's definitely showing strength. On the NASDAQ, you also have these all-time highs. Now, one thing to keep in mind, if we look at 2 years here, you see we have with this action last week and this week broken the all-time highs, and of course yesterday we added to that. So the NASDAQ, which had been trailing behind the S&P and the Dow in terms of being able to put in new all-time highs, has caught up. And yesterday was the first time since 1999 that all 3 indices set a new high on the same day. This is definitely played some catch-up because the NASDAQ had been trailing the other 2. It's now in the game and becoming a leader. And when you see the NASDAQ, which is generally growth-oriented, heavy on tech in composition, that's a pretty strong statement. So the one that is still behind, and let's go ahead and leave this on the weekly for right now, is the Russell. And you see the all-time highs back here at 1292. And we're still trading, down here around 1227. So about 60, 70 points behind the all-time high. So for the Russell, which is also very heavily growth-oriented, yes, we've set new 52-week highs, but we still got a ways to go to get to the all-time highs, which were last, May of 2015 kind of area, I believe, if I remember that correctly. So like to see this one play catch up and then, truly take the lead. If we get NASDAQ and the Russell with their growth-oriented compositions leading the market, then that says a lot more about the potential of this market to go somewhere. Now, volatility is still extremely low, so don't expect these bullish legs or bearish legs to go very far. Lots of sideways consolidation is probably the order of the day until something new comes in to give us some momentum and energy to the market, whichever direction that might push. So just kind of keep that in mind. Small volatility, low volatility, that has implications for both upside and downside. We normally associate it with the amount of fear to a downside move, but this low volatility doesn't lend us to have big upside moves as well. Okay, crude oil, of course, had a huge move yesterday. And, just when we thought we had a bear flag, here we come in with this bullish engulfing. And now we have a new higher high and we have a higher low. So this now would, in the strength of a day, was starting to call into question, whether this is a bear flag, and then invalidated that, and now we have a series, a short-term series of higher highs, higher lows, and this is looking to be a pattern that's going into more of a bullish stance at this point. Now, still lots of overhead resistance. This is the place where volatility has been running. And indeed, yesterday you had a 6% move in West Texas Intermediate crude. So we're going to continue to watch this and see what implications this might have when we start to see some tighter correlations with the broad market again. Normally, if you see crude oil moving up and equities moving up, and they're both moving up in a modest way, then that's okay, because that's acceptance by the broad market that the demand is growing and that the that higher commodity costs can be absorbed. Now, 6% moves, I'm not sure that we'd call that modest by any means. That was pretty volatile, but it certainly was a nullification move of this bit of a retracement that had taken place just prior to that. So some interesting things happen here in crude oil. We probably need a little more information to give us some clarity about just how bullish this really is after this total breakdown of this wedge pattern. And, we had a whole series of trading sessions here that were all negative. So that was very bearish. But then here we go with the last, week plus being extremely bullish and its resolution. So some interesting things definitely happening in the crude oil market. In gold, we have with overnight action, we bounce off the bottom of that triangle again, and we're smack in the middle of that, and we're coming close to the apex, and I'm expecting that at some point soon here, we're going to see some sort of resolution in gold. Now, we had triangles back here, and you see it finally broke out, just to come all the way back and just totally and seemingly invalidate that action, even went below the cloud before taking off again. So I continue to caution you on gold. Very, very sloppy patterns that normally in recent months do resolve to the bullish side, but be very patient at where it goes and getting there, because it seems to be kind of a Tasmanian devil, as it were, with how it arrives at its destination. And then let's take a look at volatility, and you see VIX here exceptionally low and just kind of humming along and in danger of really kind of breaking into below an 11. It is in a daily squeeze. Keep that in mind. That's one of those warnings out there. And then let's take a look at bonds. Bonds still in this sideways consolidation pattern and basically checking both sides of the pattern on a regular basis. No real clear indication other than the fact that this in a more intermediate term is in a bullish kind of phase, and it'd be a mistake to think that bonds are breaking down. This is still an intermediate term bullish posture, and the expectation is that it should continue to move up. That's probably enough of that right now. Let's go ahead and go to the daily report. And not a lot of changes in this from yesterday. Still market phase 3 bull flag bill. And indeed, we just had a resolution to another bull flag with yesterday's price action. And the 3 market timing signals, all mechanical in nature. The first one coming to us from IBD, confirmed uptrend, bullish. GMI index, perfect 6 out of 6. Even the GMI2 is a perfect 8 out of 8. That buy signal's been in place since 7-1. Stock charts, decision point, scoreboard, still much more messy than the other 2 mechanical signals, but it also gives us additional information in that it breaks out by index and by time frame. Short term still got mixed signals. Long term still has mixed signals. And bottom line to all this is what we like to put this all together in a consensus, and we would have that consensus as bullish at this time, but definitely with some asterisk to it. It's not a clean, healthy bull by any measure. Position sizing opinions remain at 100% for both models. Intermediate term market posture remains extremely strong bull with a supportive bullish sentiment line. Strength of trend, very strong. Hedge warning status still remains 0 plus, normal with some cautionary aspects. Those cautionary aspects are primarily about that stock chart's decision point, market timing signals being so mixed on the long and short term. In terms of strategy opinions, we still have this borderline acceptable for the VIX being so low, below a 12, which is a bit of a problem for option income strategies in that the premium that you're receiving for the risk that you're taking is starting to get out of kilter and perhaps too low for some, especially novice traders. No changes in the cover call strategies and put selling from what we've had all week. In terms of special warnings, still the same 3 kind of volatility-based cautionary warnings. 2 of these kind of a low-grade caution. The third one, more serious in the VIX daily squeeze. The only thing is that when this fires, it can fire big, and we can see a rapid expansion in volatility. But the caveat to that is that we can stay in a daily squeeze for prolonged periods of time. So just because we're in a squeeze doesn't mean that anything is imminent. In terms of the trend base, all very strongly bullish. Even the New York Stock Exchange, new highs, new lows, up over 300 on the new highs yesterday. Intermarket risk aversion indicators, still all 5 risk on, though we're putting an asterisk by this one as well. These are very, in some cases, tightly wrapped and just basically on a flat line and almost imperceptible. Really, I could call some of these neutral, so don't make too much bullishness out of these indicators at this time. Sentiment is elevated on stocks in the short and intermediate term, and we also have from the fear and greed index an 80, so up here in the extreme greed area. And what all that means to us is not that we expect a retracement anytime soon, it's that we are on the lookout for retracement reversal patterns. And extreme sentiment can be extreme, much like the VIX daily squeeze can be in that daily squeeze for extended periods of time. This can be prolonged, but we are watching for those signs of increased volatility and for those signs of reversal patterns in our price action. In terms of the sector specific, you can see a lot of healing with yesterday's action. Only telecom and utilities still holding into a relatively weak market posture, intermediate term market posture, and this goes across all 3 time frames. You see the action from yesterday. Energy was the leader on the backs of that big move in West Texas Intermediate crude, but consumer discretionary, industrials, materials, other high beta areas also performing well. The one that performed the worst was consumer staples, and it was essentially scratch. So that should be enough for today. Let's go ahead and wrap up. And of course, we always have our disclaimers. If you need more time to review the disclaimers, just hit the pause button. Also note the hyperlink down here at the bottom for the full set of disclosures. We'll see you back here for the next session for Monday with the market preview video here from Falcon Global. In the meantime, manage that risk, and you'll find that everything else falls right into place. And also, each day, go out there and look to learn something.